Joining us now is Barry Knapp of Ironsides Macroeconomics and David Bahnsen of the Bahnsen Group. Good afternoon to you both. I will start, David, with you and the fact that we have seen this recent rally. Does it continue?
Well, my view is always the same, that anybody trying to predict what will happen in the next day, week, or even month probably shouldn't be listened to. And since I want people to listen to me, I'll avoid trying to speculate. It's a coin flip. The idea of a Santa Claus rally, of some big move up near the end of the year, that's exactly what has just happened. And to get forward momentum from here without another earnings season and without any particular fundamental news to drive it, I guess the bond yields could go lower, in which case you may get more multiple expansion. But people just have to understand that that's really what's driving the market right now, is nothing more than the inverse of bond yields, just getting a little bit more boost in valuation to what's already a pretty expensive market.
So stocks continue to take their cue from bonds. And of course, we know the Santa Claus rally actually covers the last 5 trading days of the year, the first 2 trading days of January. But overall, seasonally, this is historically a strong time for stocks. November to January, it's the year's best consecutive 3-month span, historically speaking. Barry, whether it's this year or perhaps more importantly, looking to 2024, where do we go from here? And I ask that knowing that you do believe that stocks are going to struggle early next year.
Correct. At the expense of David now suggesting that people shouldn't listen to me, I am going to try and put a little more, details around this. The favorable seasonality and the rally that we've had is a consequence of what I've been describing as a Fed policy put. When 10-year treasuries went to 5%, that tightening of financial conditions really got the Fed to stop the rate hikes and essentially confirm, although they're still threatening it, that they've now are into a full-on pause. To get to an actual policy pivot, there's 3 different ways to think about things that could happen to get them to actually cut rates in the first half of the year. And I think they do need to cut rates in the first half of the year. We all know the household sector is pretty insensitive to rate hikes because of terming out mortgage rates. Large non-financial corporates are similar, but the banking system, small banks in particular, small businesses, real estate, particularly multifamily real estate, and even the banking system being able to fund the federal government, these are points of vulnerability that require a normally shaped yield curve. So assuming that the Fed will do what I think they'll do, which is to start to cut rates in the first half of the year, you have to think about, well, what's likely to cause that? Sure, inflation could continue to go lower, but they have a 2.6% forecast for the end of next year. To me, that might even be a little low. I don't think we're going to get that much more disinflation so that the Fed can cut because they can, not because they have to. The most likely cause for them to actually start cutting rates is the unemployment rate to go through 4%. I think that's likely. I think the labor market is weaker than the headline payroll gains indicate. But it's hard to imagine that happens, the unemployment rate goes up, and we don't get concerned about the earnings David was talking about. So that's the transition in the beginning of the year that I think is going to be pretty bumpy.
Yeah, David, it does raise the question, when does bad news actually become bad news for the market? And I asked that in a week where it's been really rough for crude oil. And yeah, energy stocks squeaked out a gain, albeit barely this week, but it raises concerns about the macroeconomic picture.
That's right. When oil prices are very volatile around geopolitical issues, it's harder for macroeconomic concerns to factor in. But when they weaken because of eroding demand, that can be a leading indicator to something more macroeconomic. I think that the earnings picture of the last couple quarters were very clear, that earnings probably troughed 6-9 months ago, and the decline was about 4 or 5%. From the peak. That wasn't that bad. And right now, margins are very healthy. We're going to go into the first quarter looking at fourth quarter earnings, and I think it'll be more of the same. So ultimately, your point is a good one. Will bad news actually become bad? Because right now, people have liked any data point that indicates the Fed may be pausing or weakening. The main reason, by the way, for the Fed to begin cutting is because there's no reason to be this tight. That they got way too tight for no reason. Inflation is at a 2 handle right now. if it weren't for the ridiculous shelter lag that everybody knows. The shelter is not up 8% year over year. And so real headline inflation is a two-handle now. And I also want to remind people we're going into an election year.